Good morning, everybody. My name is Doug Lind. I'm a post-secondary ag instructor at Ridgewater College in Wilmer. Was invited to come down today and do a little bit of a conversation around risk management and as it pertains to grain marketing. My background is I spent a bit of time before joining post-secondary. I spent a bit of time doing adult farm management like Brent does most of the time. And I spent about 10 years prior to that in grain merchandising. So worked with country elevators, soybean processing plants, buying and selling grain all day, every day, running trains and all that fun stuff. So the experience the perspective I'm coming at this from is just a lot of things you learned throughout the years of trading grain, and also working with producers that were, you got to see producers that were consistently better than most and producers that were consistently poorer than most. And as you watch people that are good and bad, you kind of pick up habits of what makes people, be better than some or worse than some. So first thing I want to do is just level set expectations of what we're going to talk about. We are not going to talk about current events. We're not going to talk about the USDA report that's coming at 11. We're not going to talk about the weather in Argentina. All those items are news items that change by the hour every day. You can go find that information yourself. Okay. What I want to talk about today are some of the lasting concepts that hold up throughout time in grain markets, and want to talk also a little bit about some of the straightforward, simple ways that you can use to execute and get your grain sold. So I'm sure there's some livestock people here. I apologize, I'm going to be grain heavy, but all these same concepts apply to crops as well as livestock. Okay, so here's the agenda we're going to cover. We're going to talk first about what makes a market. We're going to talk about futures market, basis market, and their interaction between the two of each other. We're going to talk about some market structures in terms of carry markets and inverse markets and what they're telling us about market conditions, as well as how we might be executing in those kinds of markets. We're going to spend some time talking about seasonal market trends. Then we'll go into some of the pricing tools that you can use to get grain sold or livestock sold. We'll get to action steps, which are just a couple of things that you can start doing tomorrow if you want to start improving your grain marketing skills. And then lastly, just leave you with the conclusion and just a couple thoughts on the psychology of marketing and how it gets difficult. So we're going to start with an activity. And you are all going to be residents of my island of Cornucopia. And I need you to split up into some groups. So I think we've got 25-ish. So I need 6 groups of 4. Okay? 4. You guys can count. Figure this out. Don't number off and have to scatter. Sit with those around you. So you guys are going to be cattle feeders. 3 here. We'll do 3 here. You guys are going to be corn growers. You guys are going to be corn growers. Let's see. You guys are going to be cattle feeders. You 4. And you guys are going to be negotiating with them. You 3 negotiating with this batch of corn growers. You cattle feeders are going to be negotiating with this difficult looking group let's see, you guys are cattle feeders. You guys are going to be corn growers then. So you guys are residents together, and you're going to have to work this out. 3, 4, 6, 7, 8. What do we got so far? 3 groups, 4 groups. All right, then we'll have a big group here in the back. So we got 4, 7, 8, 9, 10. So you'll be 2 groups of 5. Who wants to feed cattle? Who wants to grow corn?
What everybody think at once.
You guys are going to grow corn. So here's a couple of these. You can type them big enough. Hopefully you can look over a shoulder. And then you guys you'll be the cattle group opposite of that. Okay?
Sorry, you can't do by yourself.
So kind of get into your little groups. And let me introduce the scenario here. I'm sure you're reading it. But basically we are a closed system. We've got an island. And we have corn growers and cattle feeders, okay? And the trick of this is that you corn growers produce exactly 100,000 bushels of corn. And coincidentally, the cattle feeders need to buy that 100,000 bushels of corn. Corn growers, you can't export it, you can't sell it to an ethanol plant, you can't do anything creative except for sell it to the cattle guys, all right? Cattle guys, you can't do anything creative either. That's my only rule in this, is no creativity allowed. You can't pasture graze, you can't feed distillers, you can't do anything other than buy that corn, all right? You all have the same information. The only thing that's unique to your sheets is your break-even cost, okay? So I would recommend not sharing that with the other group. And the point of this is that in one transaction, you need to come to a price to buy and sell your 100,000 bushels of corn. All right? Rules of that make sense? Again, no creativity allowed. So what I want you to do is, like, for about a minute, get with your little group, you know, your cohort on the island, and make plans. All right? Then what's going to happen is after you have a full plan on how you want to go forth in this, then we'll open up to the negotiations, and we're just going to trade with one pair. So you two are paired up, you guys are paired up, and then you two groups in the back are paired. So everybody clear on what we're doing? Take a minute, build a strategy, and be thinking about prices here, because that's all we got to left to decide is how much we're going to pay and sell. Pay and get. So, okay, go ahead.
Work it out.
Figure out what you want to do. No colluding. Look at this. This is a new strategy here. I do this a fair bit. I've never seen salesmanship come into this.
Tell you what, 1150. 1150? No, we can't even do that.
Yeah, okay, 1150. Bold strategy. We'll see how that plays out, right? Okay, so you guys are negotiating already. So you cattle guys, you're cattle? Okay, so you guys are buying, so you're the bid in the market, and you guys are the offer in the market. So what's the bid? 4 1/4. Okay, what's the offer? You're already done? You guys- What? Come on. No. There's a winner here. Come on. Well, then you guys got to be the case. You guys got to make this work. Come on. Pump up the testosterone here. What's the strategy? Got her right. Okay, so you guys growing corn?
Yeah.
All right. What's the offer? Where are you willing to sell?
We think it's pretty reasonable to be around 750.
7.5 is the offer. Where's the bid? Yeah. Not even on this planet. She just told you to sell it or smell it. All right. Not even on this planet.
I think for coming down a lot, we'd rather smell it.
7.5. What'd you pay? Where's the bid?
What's the bid? What is that?
Yeah, that attitude, 250. That's exactly a good number to put on that. Yeah, then we'll have a pile of rotten corn and a pile of rotten cows. That'll smell good. Right.
You have to do better than that.
Combine's running.
Close 6. Close 6.
Corn's pouring in the semi. Cows are mooing. $6 is the offer. 6 on 4. 5 1/4 is the bid.
Wow. 5 1/4. They agreed on 5 1/4.
5 1/4 we're done. So we're 5 1/4 here. Where were you guys? 4 something. 4 1/4. How about you guys? 420. Oh boy. So I've done this 3 days in a row. So the range is, it's 420, 425, 525. Yesterday we were 505. And the day before they were real gung-ho about this process, and we got down to 445 and an eighth is where we finally traded. So it took a while. Okay, so the reason I do this exercise is a couple things. So who can tell me what's similar about the way we just transacted that grain with how it works in the real world? Any similarities there? Any similarities with how this simulation goes with the real world? We got to transact, right? We got to eventually make a decision and transact this stuff. Any other similarities with the real world? We got a buyer and a seller. We eventually just got to buck up and make a decision and get it done. Okay? You guys went much faster than the groups do. I did this in my class, folks your age in college, second year students. Even though I had just read the syllabus about no swearing in class, it got colorful. So, but the point of this is that there's some similarities, but there's also some key differences that I want to point out. Key difference number one is you didn't know what the market price for corn was. You didn't have any other influences that you could just look online and see what everybody else is paying for corn, right? That's number one. So you're kind of grasping at straws as for where you need to come, what's a good price. The second one I want to point out is that the pie in this scenario was set in size, okay? The opportunity was set in size. And what you did between your groups is decide how to divide that pie amongst yourselves. That make sense? The real world, the pie is never fixed. The pie is always getting bigger and always getting smaller. And the big point here is that in the real world, marketing is not win-lose. Here it was. If you paid $1 less, you made $1 more, right? It was a win. This was win-lose. In the real world, in the market, it's never win-lose. And if you're a cattle feeder and corn's $3, that's when you can make your decision to buy. 6 months later, if corn went to $5, then you're the corn guy and you can decide to sell. Okay, that's what we want to do in the whole thing. We want to be buying low and selling high. So let's talk about futures and basis. So to get our cash price that we're gonna sell grain for, we have futures plus basis equals our cash price. So our futures price is our benchmark price, and this is determined by all the traders coming together on the floors of the Chicago Board of Trade, the Chicago Mercantile, the Minneapolis Grain Exchange are the three big ones where we transact commodities. I think it's too bad, but unfortunately we don't have the live pit trade anymore. We don't have the groups of people yelling at each other and doing hand signals. Everything's computerized now. So the computer runs through your offer and if they can find someone that wants to buy it at that price, then it matches up and that makes a trade. Think about futures as your macro view of grain prices. This is taking all the news from the world and digesting it into one number. And with the last price where a buyer and seller met is the current price, at that moment. Futures, our quantity is standardized, 5,000 bushels of contract for corn and beans. Our quality is standardized, number 2 corn, number 1 yellow soybeans. Our timing is specified by whether you're buying May corn or July corn. That's set up. And our location on futures contracts is always delivered Chicago. So all those items are standardized. The only thing left to negotiate on is price. And that's what makes the market very efficient. Think about when you compare when you hear the corn market on the radio, it says March corn in Chicago is up 2, period. Compare that to when you hear the auction report out of the livestock barn. And we had a group of 19 white and black faced heifers weighing 600 to 800 pounds that came out of South Dakota, and the trading range on that was $1.40 a pound, right? All those items got to get discussed if we haven't standardized them. And that's a little bit of the difference between a cash sale and a future sale. And back to my point about our simulation is that this allows buying and selling to happen at different points in time of the year. A corn farmer can sell all his crop in the summer even before he's produced it with futures. And a cattle feeder can buy it as he needs it. So we don't have to have that coming together on every deal. The other part of our pricing component is basis. And the way I like to think about basis is this is your reconciling factor between what's going on in, I don't even know what county we're in. What county is this? Nicollet County. Blue Earth County? Nicollet County? Right here, right where my feet are. Nicollet County. It's reconciling what's happened right here with Nicollet County with what the global benchmark for prices are. Basis changes due to local demand and market conditions. A lot about purchaser need. Basis can be positive or negative. In this part of the world, 99 times out of 100, it's negative for corn and soybeans. Do occasionally get to a positive basis in soybeans, but pretty rare. And the way the formula works is you take your cash price minus your futures price, and that ends up being your basis. So this is a map of our corn basis across the country. This was from last summer, but the concept is, I like this one because it makes a couple of good points. And so where you see the cooler colors, that's where your basis is lower, more negative. And when you see your hotter colors, your reds, not reds and oranges, that's where you've got positive basis, in some cases highly positive basis. So let's look at North Carolina. Any hunch, what do we know about North Carolina that would say that is such a hot spot for corn basis? Second, number 2 hog producer in the country behind Iowa. Anything else going on in North Carolina? Number 2 turkey producer behind Minnesota. A lot of hogs, a lot of turkeys, not a lot of cornfields, right? Mountains and trees, no cornfields. Well, not no cornfields, not many cornfields. So what has to happen is there's got to be an incentive for a state like Indiana that produces more corn than it consumes. They're a net exporter of corn. Indiana corn has to have an advantage and a price difference to be able to draw that stuff down into North Carolina, pay the transportation costs, and get it to where it needs to go. How about this dot? I'll tell you, this dot is centered on Springdale, Arkansas. Anybody know a big company that's headquartered in Springdale, Arkansas? Tyson Foods. Almost dead center in that dot right there. Tyson. So a lot of chickens, a lot of turkeys, a lot of hogs, not a lot of cornfields. Not a lot of cornfields. So we got to give incentive to drag corn out of Kansas, Missouri, and move it into those areas. So this was middle of the summer. There's that little kind of hot spot up in the middle of North Dakota. North Dakota was an exceptional drought this summer. There's 2 ethanol plants that sit right in the middle of that dot. They usually have a lot of cornfields, but they're looking outside and they look awful. They're dying. So those guys are saying, crap, we better get our hands on whatever corn we can find stat. And so they started a bidding war against each other and make the little anomaly pocket there. So this is where we have, local conditions really do get sorted out in basis. So just a little bit of terminology on how you talk about this stuff. So a strong basis or a narrowing basis is one that's becoming, most of the time in our neck of the woods, less negative. But also if we did have a positive basis, it'd be becoming more positive. If you struggle with negative numbers and thinking about what's a bigger number and a smaller number, think about the thermometer. So I left home on Tuesday morning, it was 15 below. By the time I got to where I was going, it was 2 below. So it warmed up from 15 to 2. If that was a basis move, that would have narrowed. We would have went up in basis, had a narrowing basis. The opposite of that would be a weaker widening basis, and that's one that's becoming, less positive, or in our neck of the woods, generally becoming more negative. So if we saw basis go from a minus 30 to a minus 40, that would be indicative of a widening basis. Basis tells us a fair bit about local market conditions. It can help us identify some good selling opportunities, and it can help us decide whether we should be looking at selling now or whether we should be looking at storing grain and selling it later. Basis tends to follow some seasonal trends. I'll show you those in a minute. And one of the takeaways I'll leave you with at the end is that one way to start being a better grain marketer is to start logging some prices of the places you like to market to, and particularly on basis. You can go online and pull futures charts for 100 years if you want, but starting to identify those local basis and get your head wrapped around what's a good basis and what's a poor basis. Getting your head wrapped around that'll help you gauge what's a good number, what's a bad number. From a basis trend perspective, generally, like I said, if it always followed this trend, grain merchants wouldn't get paid so much. A monkey could do this, right? You buy low, you buy it here, and you sell it here. A few more subtleties that happen to it than that. But effectively, the general pattern is that we usually see our bottom in basis, our widest basis, sometime around harvest, towards the end of harvest. And in years where we've got bigger crops, we tend to get more negative on our basis. Particularly if we have kind of surprise bigger crops. You know what I mean by that? Where you think you got a 200 corn crop, and all of a sudden you start weighing it up and it's 230, 240. And now you kind of say, oh crap, what am I going to do with it? Right? Those are years where you can get really negative on basis, and that played a little part in this fall. Once the corn's in the bin, generally we see the trend start to go up. Who wants to put corn in a bin on November 15th and turn around and take it out on December 15th? No, tired. Forget about it. It's in there. Leave it shut. After the first of the year, you got a fresh set of tax books to work with, some cash flow things to address. Generally, we start to see grain movement pick up as we move over the first of the year. And we usually find a bottom, kind of February, mid-March. Generally, then we start to see the basis levels increase as we move towards planting. Farmers just got their minds on other things, not hauling as much corn, soybeans, wheat. And generally what will happen is that when that inflow slows down, the ethanol plants are trying to buy a little corn, keep the supply coming, so they start creeping basis up. The bean plants in town start creeping the basis up. This turnaround here there used to be a strong signal when road restrictions would come on. That was usually a signal that farmer deliveries were going to really slow down and we were going to start to move higher in our basis. Hasn't been as pronounced in the last 5 years as it was in the first five, when I was doing this in the early 2000s. But I think it's, as new bin sites went up, more bin sites got built on good 10-ton roads, and it just seems that everybody's cousin is a county commissioner. So these rules just don't really seem to apply to everybody. Okay. After planting, guess what? The checkbook's empty, and there's a sucking sound on the operating loan. Trucks fire up, get some cash moving again, and we generally see basis kind of start to wander through the summer, and then generally again hit our seasonal low as we move into harvest. Okay, next thing I want to talk about are just our market structures. So the first one is a carry market. A carry market is defined as when prices for a crop today are lower than the price for the same crop out in the future. So this is an ethanol plant up by my place, and you can see here that the numbers are a little vague, not very dark here, but February corn was $2.98, March was $3, April $3.06, May $3.06, June, July $3.10, August, Sept $3.15, $3.28 in the fall, $3.36 next December. Every month we wait, we can get a higher price. That's the definition of a carry market. Carry markets develop in the situation we're in now, where we have adequate supply to meet the immediate demand, and the market is providing you, the producer, a financial incentive to keep this stuff off the market. Okay? We're projecting somewhere around a 2.4 billion bushel corn carryout. So we need every nook and cranny to keep that stuff tucked away. So the market is providing you an incentive to say, leave it there, we'll pay you more later. That's a carry market. This is a situation where it may be worthwhile to store your grain, but you need to have a good feeling for your storage costs. So storage costs comes in two parts. The first one is your physical cost. So this would be things like bin depreciation, fan electricity, Soybeans in particular, if they're really dry, if they're 8 or 9% moisture, and you take them from the combine into the grain cart, into the truck, into the auger, into the bin, into the auger, into the truck, into the bean plant, you probably have created at least 1% of FM, foreign material, by just breaking that bean up. If you create 1% of FM, you bring in 1,000 bushels, guess what? They only pay you for 990 of them. Okay, is that right? 10% would be 100, yeah. So 10 bushels just don't get paid for. So that's the first part of it. The second part of it is this interest cost. And I'll show you how we calculate in the middle in a minute. We'll go through an example. But effectively, what we're comparing is if I sold this grain today, got a check, ran it to the bank, paid it on my loan, what is the opportunity cost of that money if I would have sold it versus just leaving it sit in the bin? It's kind of a financing cost of the grain in the bin. Anybody seen this picture before? Anybody seen this one before? So I've heard about a dozen stories that go around with this, but the best one, the most reliable one I heard is there was a straight truck, and he dumped, and he had his box up, and he started driving out of the alleyway before he put his box down, and he ripped off the bottom of an overhead bin that was full of wheat, and now is not full of wheat. So if you're looking for a part-time job, spills like that are fun. If you're a farmer, shrink like that gets really frustrating and expensive. So let's look at it. We're going to do an exercise here on calculating the storage cost. So we're comparing, should we sell our corn now in February, or should we hang on till June? Again, these are real numbers. They're a week old, out of an ethanol plant up in my neck of the woods up by Wilmer. And at the time, they're paying $3.13 for June corn and $3.02 for February corn. So when we look at the difference, we've got an 11-cent opportunity here that we can earn by carrying this grain before costs. When we calculate our cost, our interest one's easier to calculate. So we use our $3.02 that we could get today. Because if we sold it today, we'd get that check, run it to the bank, pay down our loan, and we wouldn't be paying interest on that money anymore. So let's take 302 times 5%, just a kind of a generic operating rate. And we're only doing this for 4 months of the year. Okay, so that's why we're dividing 4 by 12, because our 5% would be our annual rate for the whole year. If you do that math, it comes out to be about a nickel. And I just estimated on this one 4 cents of storage expense. Could be more, could be less. Like I said, 3 to 6 is a fair range of what this costs. If you just built a big bin setup, and you maybe got some payments on that, that's where you're going to want to be recouping that cost is through thinking about these opportunities. Okay, so we take 11 cent was our total gross carry, 5 cents in interest, 4 cents in storage, so we got a 2 cent net carry here. Is it worth it? This is a shoulder shrug, kiss your sister kind of opportunity. It's like, if I had a nice day in February, maybe I go fire up the truck and haul it, right? If the roads are slushy and salty, I'm not going to go. This is kind of a judgment call on this one. But what I do want to point out is that if you elect to carry this stuff to June, you maintain having to keep this stuff in condition and maintain your quality risk, right? So let's say we got a 10,000 bushel bin of corn. And we are dialed in to the last penny on this one. We need that last 2 cents to make our break even, and we're going to sell this stuff for June and carry it out there. So 10,000 bushels times 2 cents, I think that's $200. Okay? If we don't pay attention to the quality of the bin, and we turn 10,000 bushels of corn into garbage, we could be talking about a $10,000, $20,000 issue. So we've got $200 upside, $10,000 of downside. You got to be good. You got to be good at managing your inventory to make sure that you're managing your risk appropriately with that as it comes to your inventory. That make sense? If it was me, I probably would carry it, and for the sole purpose that I don't want to have to drag my power washer off and wash the salt off my trailer in February. But that's the only reason I wouldn't. The opposite of a carry in the market is an inverse in the market. And an inverse in the market is characterized by a situation where we have prices now are higher than prices later. This happens when when we've got very tight supplies and the market is saying, bring it now. We need everything you got. We need everything you got now from a supply side. And we're also telling the demand people, wait as best you can, pull your bins down to nothing. We got to suck every bushel out of the market that we possibly can to get through. You know, this it happens in times of, where we had some short crops. 12, 13 were good examples. The soybean market essentially was inverted my whole career when I was in commodity trading. I started doing it in 2006, and then we came to the dawn of ethanol and everybody planted a pile of corn in like 2007 is kind of when that really got kicked up. And from there, we were in a shortage of beans, an inverse in the bean market from effectively 2007 to 2016, 2017, when we barely had enough to get by. And the market was always saying, please clean out the bins, get them into town. And on the other side, telling the demand people to just, run on the very bottoms of your soybean meal bins, and because it's going to get cheaper in the future. Okay, that's what the market is saying in an inverse. Okay, next thing we're going to talk about here is about seasonal market trends. And the way I like to think about, growing the crop, right, is we've got a few checkpoints we have to get by to make sure we grow a good crop. I think the Olympics start tonight, so I'll use a skiing example. I usually use a hurdle example, but I'll use skiing because the Olympics are coming. So if we've got Lindsey Vonn on the top of the ski hill, and she needs to get to the bottom of the race to be successful, okay? So when she's in that starting gate, there's all kinds of things that can go wrong from the top of the hill, all right? Then as you start heading down the hill and you make it through the first couple of gates, and the closer you get to the bottom, the less gates you got to ski through, the more you're sure about the outcome, right? And then once you cross the finish line, you go, yeah, we made it. There's really nothing else that can effectively go wrong in that situation. So these checkpoints or those gates happen in our production cycles of a crop. The first one we got to get through is we have to get adequate acreage. We have to provide enough incentive to get enough acreage to plant the amount of crop we need. This was a bigger deal when we were tight on corn supplies and tight on soybean supplies. Think 12, 13, that was a bigger deal. Now, nobody cares. We got too many beans, we got too much corn. They were like you guys negotiating where it's just like, okay, you want 1 million acres? Oh, you can just have it. Soybeans, you can just have it from corn, right? In the old day, in the last, when we had these really tight scenarios, you had the corn guys and the soybean acre guys bound in heads, both running up their respective prices saying, we need more acres. Not as big of an issue now. That's kind of the first gate we need to get by. The second thing that needs to happen is we need to get this crop planted. You'll notice we get right here, kind of on the eve of planting, or in the middle of planting, late April, early May, we tend to get a big jump. And what this chart is this chart is 5 years worth of price history indexed and smashed into one line. So this is all the price action from 2012 to 2016. So we get the acres. Hey, guess what? We got through that gate. That's not as a concern anymore. Then there's always this panic. Happens on our farm every year. Probably happens on all y'all's farm every year. Where it's like, oh my God, we're never going to get this crop planted, right? It snowed on the 3rd of May last year in northern Minnesota where we farm. And it was this huge panic, we're never going to get this crop planted. Then all of a sudden, 2 days later, the sun comes out and we're done in 4 days. And it's like, oh, okay, well, that's not a big deal. That's this thing. That's this here. We had to ski around that next gate. Then we chop around, crop gets up and get going. And the last big one we got to get through is get through our pollination cycle on corn. Usually you start seeing that, kind of late June, kind of to the middle of July is when you really start getting zoned in on those weather forecasts. And it always seems that in the last few years, in fact, when you once we get to kind of around the 4th of July, those 10-day forecasts are getting out to July 14th, 15th. And that's carrying pollination time for a lot of the country. And once you kind of get those weather forecasts and it's not 100 degrees and 0% chance of rain across the whole country, then we kind of say, you know what, there's nothing but clear slopes ahead here. Let's just coast down to the finish line. That's the way these seasonal market trends kind of work. Does that make sense? Kind of in my analogy there of how we got to get through these each one of these events. So different things resonate with different people. You can kind of see those in the lines. But what I'm going to show you next is I'm going to put up arrows and down arrows. The up arrow is where we achieved the high for one of these particular years in the cycle. And then there's a down arrow, that is where we achieved the low for one of these particular years. So one year we had our high there in middle of March, beginning of May, mid-June, mid-July. And the red arrow is the 100-year drought, 2012. So a bit of anomaly, but we still put that price action in these numbers. So in 2012, that was a disaster. We didn't know where the crop was, and the market didn't peak out until the middle of August. Then where did we hit the lows? So 2012, again, the anomaly year, we hit it right early in the growing season before it turned hot and dry. Then you go low there in mid-August, early Sep, late Sep, and way out in the middle of November. So, like I said, some people the line resonates more. For me, the arrows resonate a little bit better. Because if I draw a line right here, and I throw out the year with the 100-year drought, all the highs happened over there, all the lows happened over here. Okay? Does that make sense? This is only 5 years. You do this for 10 years, it looks the same. You do this for 20 years, it looks the same. Okay? The trend has been about 8 out of 10 years that we have had spring prices exceed our fall prices, with a few anomalies mixed in there throughout the years. So, how does this impact marketing? On our farm, I'm a firm believer in this. I try to sell more of my crop in the beginning. I try to be 50% sold on my new crop by the time we go to the lake on 4th of July, and I am out of old crop by the time we get out of cell phone reception going to the lake on 4th of July. There's a truck stop where we drop phones, where the phones drop off, and we've sat in that parking lot before and sold corn, because that's what we put our foot in the ground, that we are not going to carry corn beyond that. And it works. We're never all the way right, we're never all the way wrong. It's about risk management. So look at the same thing with soybeans. So I won't go through the methodology, but I'll just show you where the arrows land. We had one out there in January, mid-April, June, another in June, and then our 12-year, we didn't make our high until far out in September. The lows, we made a January, another January, an August, an October, and a mid-November. Historically, the seasonal relationship in soybeans, seasonal price trends in soybeans haven't held up near as well as they have in corn. Anybody have a hunch why on that one? South America. When we are fixing to plant, they are fixing to harvest. Okay? Brazil is getting almost done with their crop and ready to harvest. Argentina, you just got to flip the calendar, right? So if we add 6 months to February, so we're in the second month, we add 6 months, that's August. August an important time for growing beans? Heck yes. It's Argentina's August equivalent right now. So we're always in a weather market on soybeans. My hunch is that corn will start to take on this pattern more as South America becomes a bigger deal in corn production as well. They're a big deal in soybean production, and they're an up-and-comer in corn production. So it very well could be that the next 10 years of corn trends won't look the same as the last 10, with that South America becoming a bigger deal. So personally, I'm not as big of a believer in the soybean trend. When we market soybeans, we just work on quarters. We sell the first quarter by the 31st of March, sell the second quarter by the 30th of June. We do sell a little bit deeper into that because August is so important for soybeans. Get our third quarter sold by the end of August, and then we usually take the last quarter across the scales and sell them, because Maybe you guys took a lot more agronomy classes than I do. I'm an economist by trade, but I can't walk through a bean field and tell you the difference between 40 and 30 bushel beans. So we've been wrong on that before, so we kind of leave that last quarter up to see what it is once we start getting there. Okay, so now, next part here we're going to move on to is just talking about some of these real basic ways that we can get our crop sold. All right, so follow with me on this chart. So what do we think? We got to decide what we want to do. Bearish means we think the market's going to go down. Bullish, we think the market's going to go up. Okay? So we're going to start down here. We think futures are either at a good level or have a better chance of going down than up. We also have the same view on basis. It's either plenty acceptable, historically good, and we think there's more, the better odds that it goes down or widens than narrows. If we're of that opinion, we should be just looking at doing a cash sale. This is the oldest trick in the grain business. This is you bring me grain, I give you a check. All there is to it. When you make the sale, it is the simplest one you can do. It does generate cash flow immediately if you're selling it, for now shipment. And the advantage of it is that you have taken all your risk out that prices go down or basis widens. You've got locked in. The price you got is the price you'll get. The disadvantage to this is the price you got is the price you get, okay? And if something happens and markets go up a bunch, you're on your own. You get where you sold it. So you don't have that opportunity to participate if we get improvements in futures or basis. I would guesstimate that 65% of the crop in the U.S. is transacted this way, 70% maybe. This is the oldest trick in the book, and it's the way that most people do it. So don't feel bad about grain marketing if you aren't using the most complicated things. This is the way that probably most grain is getting transacted. So let's go back to the chart again. So now let's go down the branch here where we think futures are at an acceptable level or have more chance going down than going up. But we really don't like the basis posted up at the elevator. We know that historically our basis is minus 40 and the elevator is minus 60. So my hunch is that I think that basis, well, this is my hypothetical hunch. My real hunch is opposite of what I'm about to say. My hypothetical hunch is that I think basis is going to improve. I think basis is going to go from what the elevator is posting kind of a nasty number out there at minus 60. I think it's going to get better in my favor. So what you might look at doing there is called a hedge to arrive contract. And hedge to arrive, what we're doing is we're locking in our futures price. We're leaving our basis open. That's all we're doing. So the advantage of our sales price now is based just off the futures price. The advantage is if we're of the opinion basis is going to get better, it gives us time to accomplish that without having the futures risk at the same time. We do get some flexibility on delivery timing. I'll go through an example on that. The disadvantage of this is that the elevator is going to be, the elevator, the plant, or whoever is carrying a hedge for you. And they're going to charge you something to do it. 2 to 8 cents is a common number. As commodity prices go up, it gets more expensive for the elevators to finance these, and they'll charge you more. So now that we're kind of low on prices, our prices are low on the 2 to 3 cents is a common number on corn, 2, 3, 4 on corn, 6, 7, 8 cents, 5, 6, 7, 8 cents on soybeans, common numbers out there in the marketplace today. The other disadvantage is that this takes 2 actions on your part. And so if you don't like making decisions, going into a hedge to arrive contract, you've just doubled your decisions you need to make. Cash sale, make a decision, 1 call, done. Hedge to arrive, you make 1 call to initiate the futures part of it, and you got to call back and make a second phone call and pick the time when you want to set the basis. So you do have 2 separate actions there. So, as an example, it's February. We like the price of corn for June delivery, but we think basis level has an opportunity to improve. We're going to go ahead and lock in a hedge to arrive. So we've got $4 is our futures price, which we have locked in. Today the elevator was saying that they would pay us minus 50. We said thanks but no thanks on that. We're going to leave that open. So today we could have locked in 350, but we elected not to because we think basis is going to narrow. Guess what? We're right, and now it's April, and we've seen that basis strengthen by 10 cents. So basis moved from minus 50 to minus 40. Call the elevator, say, hey, now go ahead, lock my basis in at minus 40, and it basically just becomes like a cash sale. So our $4 futures price is unchanged. That was locked. We've now done our basis, so we've established a $3.60 cash price on our corn. You can go the other way too. You can be wrong on basis just as well as you can be right. The other advantage of a hedge to arrive is the ability to roll these. And I'll start with a disclaimer that this is not, hedge to arrive is not a standard contract. ADM has different rules than CHS. Cargill has different rules than both of them. The co-ops all have their own set of rules when it comes to hedge to arrives. So before you get into hedge to arrives, know what you're doing. Know the rules of the people you're doing it with. They're all going to have different fees. They might have different timing dates on when you have to decide if you're going to haul it now or roll it. So I'll preface this with just saying you got to know that, because there's no standard across the industry for how these work. So hypothetically, it's June, and we sell some corn on a December futures hedge to arrive contract at $4. We left our basis open. And our thought is we are going to haul that corn at harvest, and we'll just set the basis down the road. Well, once we stick the combine in the field, the yield monitor is less than optimistic on the crop, and we realize that we can now store 100% of this stuff on our farm. We look at the market, we see we're in a carry. In a carry market, our July futures, next July, so in this scenario it would be like July 19, are trading 25 cents higher than December. If that's the case, we want to be able to earn that carry. If it's more than our storage costs, pick up the phone, call the elevator, say, hey, I would like you to roll my contract to next July. Then what they do is they take your $4 December price that you locked in, add 25 cents, and now you've got a $4.25 next July price that you're working off of. Still need to set the basis somewhere down the road, but you've got a little something going on and have helped earn the carry. Okay, we'll go back to the map again. So now in this case, we are going to be a standard farmer and think the prices are going to go up. Okay? We are hoping prices are going to go up, but for some reason we are a little bit concerned that basis may widen. We're looking at our basis around, and it's historically a good number. And so we want to protect the basis while leaving our opportunity open on our futures. So in this case, we're going to do a basis, it's called a basis only contract. Exactly the flip-flop of a hedge to arrive. Hedge to arrive, we did futures first, basis later. Basis only contract, we're going to do basis first and futures later. So what we're going to do is we're going to look at the bid sheet and say, you know what, I like that 55 under for June. And I'm going to call them and say, hey, I want you to lock that basis in for me, but leave the futures open. I think they're going to get better. So our advantage here, again, it's simple. Allows time for futures to appreciate. The other advantage that's not here is that it does secure a home for your bushels, which, depending on how many market opportunities you have, or, if you're hauling to some hometown elevators that can just get full at harvest and just say, thanks but no thanks. We're kind of past that in most of the grain elevator buildup, but it does happen in some areas where people just get full and just say, see you next year. So it does lock in your home on so you've got a place for your grain to go. The disadvantage, I talk about that as an advantage, I'll talk about a disadvantage too, is that anytime you set your basis, you have now established where that grain is going, the physical grain, where it's going and when it's going there. So you don't have some of the options that you do around rolling contracts or some of the other things. But anytime you set your basis, you know where it's going and when it's going there. So as an example, just the flip-flop of one we did before, futures are $4, basis right now is at 20 under, so we hypothetically could lock in a $3.80 cash price. We like our minus 20 basis. We're going to elect to lock that in, but we think futures are going to go up. Hey, and guess what? We're right, they did. So we're right, they did. Futures moved up from $4 to $4.20. We still got that minus 20 basis locked in already. Call the elevator, call the ethanol plant and say, hey, I like this. I like the futures at $4.20. Lock those in. They take $4.20 minus your pre-established basis, and you're you get $4 printed on your check. The last one is the uber bull, right? We think futures are going to get better, and we think the elevator is being a little greedy on basis. We think that both of those have the opportunity to get better, and this is where we're going to go down a path of either entering a delayed price contract or we're just going to be sitting and waiting. So here, a delayed price contract, you are going to deliver grain and on a contract with the elevator, and you will sign a piece of paper that agrees to their terms, where you will agree to establish your price by some date in the future. The advantage to this is that it is simple. If you do have that bin of corn that's maybe a little dicey on condition and you're not sure if you want to hang on to it, when you haul it in, the quality risk becomes their problem and not your problem anymore. So that is one way that you do transfer your quality risk, and you do get to stay in the market on both your futures and your bases. Disadvantage to delayed pricing. Generally at harvest delivery, there's a monthly fee on this one, 3, 4, 5 cents, depending on the size of the crop and who you're dealing with. Lately, the trend, in some areas, this is part of the world I don't know all that well, but in some of the areas, elevators and plants have been saying, after harvest, saying just haul it in and we will price it later for you at no charge. If you're hauling this stuff in at harvest, usually you see some additional shrink and drying charges, where an elevator will take it down to, let's say, a 14% moisture on corn instead of a standard 15%. So if corn is $3 and they take an additional 1% of shrink, that's 4.5 cents is about what that works out to be, that extra little bit of moisture is worth. The last disadvantage of this one is anytime you enter into a delayed price contract, you sign a piece of paper, and on there in Minnesota it says that you are entering into a voluntary credit sale with whoever you gave the grain to, which in layman's terms means I have given you my grain and I'm taking the risk that you pay me sometime in the future. If you're doing, let's say, a cash sale, and I haul my grain in on a cash sale, and I call the elevator the day after I'm done hauling and say I'd like my check, and they can't pay you, there are some bonding things that are there to protect the producer. There are some indemnity funds, they're called, that have some money to help protect the producer in case of a failure. However, if you enter into these contracts that are voluntary credit sales and the elevator can't pay, you're up a creek, right? I'll preface this by saying I don't panic, right? These are rare. There's one that happened 100 miles west of here a year and a half ago. There's another one, a big one out in South Dakota, another 100 miles past them, that have cost local farmers a couple $1 million by the elevator just not being in a financial position to pay when the time came. So, again, rare, but does happen, and might just want to just think carefully about who you're doing these with. Do these with people that you trust and have a good feeling about their financial condition. These things, again, they're everybody brands them a little different. Some people call them delayed price, DP. Some people call them price later, PL. Some people call them NPE, no price established. And a couple marketing agencies call these DP, dumb producer. But I won't be quite that hard on people that use it. But you have just allowed yourself to kick the can down the road on these and not make a decision. Okay, so we're nearing the end here. And so what I want to leave you with here are just a couple action steps. If you want to get on the path to being a better marketer, here are a couple things that I think you can do starting tomorrow to get after this. First and foremost is start tracking and logging markets. Weekly basis is great, daily basis is fantastic. But just on a consistent level, look at the couple places you maybe market your grain to, and say what is their price for the month we're in, the price for February. Maybe if you sell a lot of corn in June, maybe write down the June price, and maybe write down their harvest price, and write down the futures price, the basis price, and the cash price. Everybody's got a website now. Just jump online and take a look. That's number one. along with this, anytime you make a sale, I think it's a good practice to just make a note of what you did. This was my to-do list here over the last couple. This was on my marketing to-do list, was to sell 25% of our new crop beans at $9.50 cash, and I gave myself to March 1st to do that. I got that done about a week ago, a little more than a week ago. And what I do with this is I've got a notebook and I write down why I did that. I did that because it's above our cost of production. It's the market's been kind of choppy, and I'm concerned about export pace, and I just want to get that first quarter sold. And the reason I do that is that if we get to harvest and beans go to $12.50, and I'm at the elevator and everybody else is doing a conga line dumping their beans for $12.50, and I'm slumped over the steering wheel because mine are only worth $9.50, I have something at least to look back at and remember where my mindset was when we pulled the trigger on this one. The next one, find a information site that you like. Find 1 or 2 information sources that you like, not 5, 6, or 7. Okay? You can take the same news event and look at it on MSNBC and flip over to Fox News, and they'll be talking about exactly the same thing. And one, it's the best thing that ever happened in the world, and on the other end, it's going to be the key to start Armageddon, right? The news events are interpretable, and what you need to avoid is called analysis paralysis, all right? I can always find, if I have 8 sources that I'm getting information from, I can always find somebody that matches up with what I'm thinking. But if I get 1 or 2 that I consistently listen to, that's going to help me be able to make some good decisions. Dial on cost of production, that one's coming up here shortly on how to do that and why it's important. But knowing where you got to be on cost of production is the first thing you have to do in a marketing plan. You know, how do you know what you're shooting for if you don't know where you're starting from? And a buddy of mine, he always says, and this is kind of back to my selling beans at $9.50, his saying is that you can never go broke making money. And even if everybody else sold their beans for $3 more than me, if that was a profitable sale for me, I will never go broke making money. That's a fact. Do formulate some price targets in selling windows. Both, look at things that have both a price target and a window, okay? So, like I said, our beans we break into quarters. I like to get those done. I wanted to get those $9.50 beans sold, got them done. That just moves off my to-do list. And now we're just working on our second 50% that I've given myself to the end of June to get those sold. So I'm gonna pick what I think is a good price between now and the end of June and get them done. And lastly, just explore, execute, and evaluate. So this is where keeping your log of what you're doing is a good thing. Just remind yourself what you're doing. Try something a little bit out of your comfort zone. And just then go back and evaluate what your frame of mind was, what you're trying to accomplish, and whether it did or didn't do what you were hoping. Lastly, this is where I'm going to talk at you, not to you. I'm going to talk at you on these ones. Okay? Marketing takes courage and conviction. Marketing is tough. So let's imagine you're at the farm and that beautiful 80 right at the end of the driveway has come up for sale. You've driven by it your whole life. You know everything there is to know about it. You've dreamed about farming it your whole life. It comes up for sale. Go to the bank, make a deal, get it done. When will you know if that was a good decision? When will you know if you made a good decision on that? 1 crop? 2 crops? 3 crops? Somebody say a number, because I'm just going to keep going, because you just took out a 40-year loan on this thing. 4 crops? It's probably going to be, it's years, right? Years and years before you know if that was a good decision. And why marketing is so tough is that if I sold 10,000 bushels of corn on my drive down here, and when I catch the noon markets after lunch, I'll know right then if I made a good decision or not this morning. And if the market's up 10, I'm going to say, you know what? It's only noon and I've already made $1,000 worth of bad decision today. Right? It takes me to my next point too, is that we got to be thinking about risk management. And our risk as people that produce things is that those prices go down. I've got a guy that's your age that sits in the front row of my farm management class, and he got 1,000 bushels of beans on wages last year. He brought them to the elevator and he re-owned them with one of their futures contract deals. And every day he walks in and he goes, Doug, did you see beans are up 2? I made $20 today. Doug, did you see that beans are up 13? I made $130 today. Do you see beans are down 16? I lost $160 today. I finally said, Jared, you got to stop this. You got to stop this. You got to think long haul on this stuff. You are going to grow 50 more crops in your life. If we sit here and dink around with that last 1,000 bushels that you planted 9 months ago, you're not going to be able to do this. You need to just stop. We need to be, he's concerned that prices go up and he misses out. When our real risk is that prices go down. Our risk is that prices go down. So continue to think about that. Make a sale. There's lots of ways you can re-own stuff. A lot of people spin their wheels on that. I don't personally do it. I just try to keep looking out the front windshield on this stuff and saying, you know what? If I sold and the market went up, guess what? I'm going to grow 30 more crops that I can sell into that higher market. Okay. And that's these last 2 points. You were in this for the long haul. You're going to grow 30, 40 crops in your life. 50 crops. You guys are that young. We got to think about this from the long haul. And the last thing you need to do is that when you sell and the price goes down, you feel good, right? If I sold 10,000 bushels and the market went down 10 cents, and I heard that at noon, I would pat myself on the back and say, hey, you made $1,000 worth of good decision. It's only noon. That's completely backwards. It's completely backwards. You should only ever hope you sell and the market goes down. If you've sold the last bushel you're ever going to grow ever, and you've sold everything that has a value, every asset that has a value tied to the price of corn. So every shed is empty. Only the lawnmower sitting in there. Every shed is empty. Every piece of farm real estate is sold and gone. Then you can pat yourself on the back when markets go down. Having a plan and being able to move this stuff along is just, it does take a little bit of the stress out of your day-to-day and just the concern about what's going to happen. So appreciate your time. Thanks for having me, and hope you picked up something.